Following the blowout September jobs report, swaps are now only pricing in 39 basis points of cuts between the Fed's final two meetings of the year, with less than a quarter priced in for the November FOMC meeting. So is the Fed's rate cutting cycle on hold? Let's discuss with Ben Emons. He's the FedWatch Advisor's Chief Investment Officer. Ben, it's great to have you here. So let's talk about maybe this shift that we've been seeing in terms of the pricing of what investors and what traders are expecting to see over the next couple of meetings from the Fed. Do you think the argument that the Fed is going to remain on hold, does that make sense given what we know?
Actually, it does not, Seana, because if you listen carefully to Mary Daly last night, she actually voices the view within the Fed of why these rate cuts are needed. Right? They want to build an insurance to make sure that the unemployment rate doesn't move away from them, actually doesn't meet their forecast, which they have set at 4.4% by the end of the year. And we're currently roughly about 4.1, right? So they are clearly concerned that the labor market has some form of deterioration, and they want to prevent that from getting worse. So in that sense, this Fed is not in a mode here to say, hey, we'll put everything on hold. Of course, they can skip a meeting. That's always been the case, even during tightening cycles. But what I think they're assessing is that we gave the economy kind of a push with this 50 basis point cut. We're seeing the numbers start to play out. If we're right, then we can continue to cut, but maybe at a slower pace. And I think that's what the market is pricing. If you look at the number of cuts now priced into March of next year, there's about 3. It was about 5 just after the FOMC meeting, about 8 before the FOMC meeting. So you can clearly see the change there. And I think that is what's driving the 10-year yield higher. So it's really the Fed that wants to keep cutting, but the market is assessing you can do this probably somewhat slower from here while you guard for this labor market.
Well, given that, Ben, I'm curious. We know that credit spreads are tight. We've got consumer spending still remaining strong, and the labor market, at least for now, looking okay. Is there a risk there of reinflation?
I think there is, Maddie, but I think it also depends much on what's happening with geopolitically in the Gulf region in particular. What happened with Israel sort of taking control in the war of Gaza and not attacking the Iran facilities just yet. I think that's what we have to watch, because if anything of that changes, I think that's more your inflationary impulse to markets overall, as opposed to this idea of like, yes, we're giving the economy some acceleration with this rate cut, but we also did this through the equity markets and loosening of financial conditions. But it's really to keep the economy actually on track, as opposed to letting it weaken further in order to get our outcome of 2% inflation. So you want to watch what's happening with commodity prices, really. I think if we're getting more turn higher there, which may happen, or some sort of exogenous shock, then that would drive inflation expectations, as opposed to the Fed themselves, which, for all their purposes, they remain reserved, right? They just want to go slower in that tempo.
Ben, is that the most important, not so much indicator, but trade to watch then ahead of the next Fed meeting?
Yeah, I do think it is, because ultimately, I think what markets are looking at is that we currently are what it feels strange, but we're like in a totally certain environment, meaning the markets don't see much tail risks, neither do they see any kind of election outcome uncertainty. In fact, there's a view in the markets that this Republican Congress is actually going to happen, and then whomever will be president, Republican Congress will drive forward all these measures that people are looking at to price into the markets, as in lower corporate tax rates, more reshoring, and these tariffs basically trying to balance the budget. So I think it's really that aspect of certainty in markets that is the indicator against the commodity markets that are potentially at risk of a flare-up of geopolitics.
I want to talk about what we're seeing in the dollar, because we're seeing some speculation and some trimming of dollar shorts ahead of the election. But I wonder if we could see the opposite, particularly if we do get a bear steepener. Could we potentially see, and because dollars are at such high levels at the moment, could we see a potential weakness on the dollar on the heels of that election?
I think it matters of more how the dollar will weaken what the economy ultimately does. Let's say that there's bear steepening, which means that long-term rates rise more than short-term rates, that really starts to affect the economy again negatively. I think that's when the dollar will turn from the strength to weakness. Because as so far as we've seen, the dollar has been strengthening as these rate cuts are somewhat priced out, but it's really the acceleration that started early August in ISM data and other PMI data that's coming through now. You see this morning, another regional manufacturing data is stronger. that lifts the dollars. Really, the dollar's kind of trading on the economy. So if higher rates and bear steepening eventually slow the economy again, I could see that dollar weaker. I'm not so sure if this has anything to do with the election in itself, because we know the deficits will stay large, and the dollar hasn't responded much to that at this moment. It's really about the economy, I think, where the dollar ultimately heads to. Looks to me the economy's strong, dollar stays strong.
All right, Ben, we got to leave it there. Really appreciate you joining us this morning. Thanks so much.
Thank you.